This quick question is about investor ratios, in particular dividend cover. And the question is a dividend cover of 0.6 good or bad? Dividend cover indicates whether the dividends paid by the company to the shareholders can be afforded out of the profits currently being made. Let's represent profit by blue and the level of dividends being paid represented by orange. Here, profit is higher than dividends. Dividend cover is calculated as profit for the year after tax divided by the total dividend paid. So it's a fraction. In this case, profits are higher than dividends, and so the calculated dividend cover will be greater than 1. This is considered to be healthy because the dividends being paid can be afforded out of the profit currently being made. However, let's look at the situation the other way round. Again, profit is represented by blue and dividends by orange, and in this case, the dividends are higher than the profit. Dividend cover, calculated as profit for the year after tax, divided by the total dividend paid, in this case calculates to be less than 1. So as in our question, for example 0.6, this would be a cause for concern because it's not clear why the dividends being paid are so much higher than the profit that's being generated. So let's look at why this might be the case. A dividend cover of 0.6 is likely to indicate that dividends are being funded from previous retained earnings rather than current profits. Examples of explanations as to why this might be the case include the following. It could be that shareholders are demanding higher levels of dividend, and therefore there's almost an obligation for those high levels of dividend to be kept up, even though the current profits don't necessarily suggest that that's the right thing to do. Or it could be that the company is doing worse than previous years, but doesn't want to risk upsetting the shareholders by reducing the level of dividends, and therefore previous retained earnings are used to fund them. Both of these situations are a concern because it suggests that the levels of dividends being paid are likely to be unsustainable in the future. However, it could simply be the case that the company has decided to release previous retained earnings as they aren't needed for expansion or asset purchase that they were originally put to one side for. In this case, using the previous retained earnings to fund dividends is a perfectly reasonable thing to do. So the answer to the question whether a dividend cover of 0.6 is good or bad really does depend on the explanation as to why those levels of dividends are being paid. So there isn't a straightforward answer to say it's either good or bad. It simply depends on the reason why those levels of dividends are being paid. Please visit our website, studytheeasyway.com, to find out more about how we can help and support you in your A-level accounting studies. You can also find us on Instagram and TikTok.